All right, welcome back. Today we're going to do a brief training on some of the basics of financial planning. One thing that everyone is concerned about when they're planning or what is going to be, or what are the tax implications of whatever strategy that we decide to implement. So today we're going to look very briefly at the tax situation, but we're not going to focus exclusively on taxes. This is more so how do you build a financial future. We call this the sacred geometry of financial planning. In this first sphere, we have things that are going to be always taxed. This makes up products. These are like your CDs, your stocks, your bonds, mutual funds, ETFs, commodities, currencies. Whenever you make a profit on these securities, you are going to be taxed. The second sphere actually are things that's going to be taxed later, at some point in the future. Now, the second sphere, that corresponds to accounts. In here are your things like your 401k, your 403b, your 457, SEP simple plans, traditional IRAs. The IRS is saying, you know what, put money into these type of accounts now, and then we'll let your interest or whatever profit you make grow tax deferred, and at some point in the future, we'll tax you on it. All right, so that's your tax later bucket. The last sphere is your now. These are going to be the accounts that are going to be taxed now. The most common example there are your Roth IRA and your permanent life insurance. And the way that these work, whatever your income is, or whatever your source of funding is going to be taxed now at its current rate, and it's going to be growing tax deferred, but it will not be taxed again in the future. The reason why this is so attractive is because now we know that we're living in some of the most historically low tax brackets. We know at the height of Eisenhower and in the 50s, 60s, and 70s, some of the highest tax brackets was at 90%. So right now, when we're looking at tax brackets of like 30 or 40%, it'll change our strategy. Now, so that's just the foundation. So if you look at this and we think back, when we were playing with blocks as children, this is not a very stable structure. So how do we add stability to our financial planning? We do that by encasing it in a triangle. Now this triangle actually represents the stability to our plan. And why is it stable? Because if we don't have this triangle in place, now let's say, something happens, the unfortunate happens. The first thing most people do is they start liquidating their accounts. They start selling the stocks, they start selling the bonds, they start selling the CDs. Then what do? If things don't get better or if things continue to get worse, they liquidate some more accounts. And then they go up here and then they take out their later accounts, their 401ks or 403bs. And then if things continue to get bad, they liquidate all the rest of the accounts and securities that they currently own. So how do we go about preventing this? Number one, we have to make sure that we are properly protecting our assets. The first and best thing to do in order to protect your assets, get the black mark right here, is through life insurance. Depending upon where you are and what stage of life you're in, will determine what type of life insurance you need, whether it's the permanent kind, the term kind, or a combination of the two. The next thing you will need is disability insurance. I asked a lot of clients, what do they think is their number one asset? The number one asset is their ability to create or generate an income. If you do not have disability insurance and something happens to you, you have just done away with your best asset, your ability to generate an income. And the last thing that we need is long-term care. Now, most people think that long-term care is something that I don't have to think about now, but as with most things, the longer you wait, the less or the more it's going to cost you. So think about, when the budget permits, incorporating all of these different things. Now, just lastly, there's going to be one other thing that we're going to go over on the basics of financial planning. When we look at the matrix of how do we decide what to have in our portfolio, there are a couple of considerations. Along the top, we have time. Anything from 1 to 3 years, 3 to 7 years, and anything 7 years plus. And along the side, we have our liquidity, we have our risk, and we have expected return. So now when we're looking at anything where we have a high liquidity concern, meaning we want to be able to get our money back quick, that's going to be here in the 1 to 3 years. Anything that we can, let sit there for some time, we have a lower liquidity concern. That's anything 7 to 7 years or above. 3 to 7 years, we can pretty much go either which way. Risk. We want our risk to be lower. If we need our money back in 1 to 3 years, we want a lower risk. 3 to 7 years, again, we can go either a little bit more risky, a little bit less risky. But if we're at the 7+ years, we can take on a little bit more risk. And down here, the expected return, anything that's 1 to 3 years, we know that we're not going to get a high rate of return. Just think about your common CD. The return is very low. Our 3 to 7 years, we actually want a higher return. In 3 to 7 years, then we'd want it in 1 to 3 years. And then anything with 7+, we're looking at an even more significant amount of return. So again, this is just the basics of what we do as financial advisors when we're sitting down with clients. So again, I hope you enjoyed this training. Thank you very much and look forward to hearing from you soon. Bye-bye.